Bitcoin rallies 10% on the week as key support at 60k holds, and we test the top of the range at 66k. If an upside break is confirmed this week, that paves the way back to all-time highs. Could this finally be the move we've been waiting for? Find out in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Larker from Options Insight. I've got my man Dave from FRNT. And we're back again. Crypto Options Unplugged. The market's rallying, mate.
We're pumping.
Yeah.
We're pumping. I think we triggered the banana zone.
Yeah. So we obviously we ran a giveaway last week. We were giving out some hoodies. The lucky winners, I said I was going to announce them this week. So we've got Dennis Wachter. Apologize if I'm not pronouncing that right. Marina Kawaja and Peter Linton. Congratulations, guys. The hoodies are on their way to you. All right. So the banana zone, is it finally happening?
Tentatively, it looks that way, right? It definitely does.
67k as we speak, right? I think.
Yeah, and we were sort of breaking through that. Mate, it just looks so well set up.
What's the macro developments this week?
Obviously, still so much focus on China. So on the weekend, we had the fiscal announcement that everyone was kind of anticipating. It was kind of disappointing in the sense that they didn't actually put any numbers around it.
Yeah, I thought the Chinese market might tank on that, but it kind of held in there, right?
It's a weird one though, because I guess like the key kind of takeaway from it is they've said that they're gonna raise more debt, they're gonna increase fiscal deficits, they're happy to do that, they're gonna recap the large regional banks. They're gonna also, like with the sort of debt that they raise, they're gonna help the local state banks like refinance their kind of off balance sheet debt. And I've always argued this, like people always want to talk about the China blow up. Like at a local level, there's massive issues, massive debt issues and balance sheet issues. But at the state level, there's not. And the state are always going to bail out the local governments and whatnot. So they've kind of had this like almost very like, it just feels to me this like Draghi-esque, whatever it takes, open-ended kind of nature.
But the market believes it for once now.
Yeah, the market believes it. The market, where I thought maybe the market might not respond too well, is that it might be disappointed that they've not been given a number, and the market wants a number, but almost like the lack of giving a number gives this open-ended feel.
Aren't they going to have to give a number at some point?
Yeah, at some point they're going to, right? Yeah. And there was...
Is there a date or is there a deadline on that?
Yeah, there's stuff that's coming out at the end of this month that they're going to announce some measures. There was a prominent economist, forget his name, in China that was floating today a 10 trillion yuan number, which is what, about $1.4 trillion.
Whoa, that's huge.
Yeah, so big. Okay. We're talking big numbers. And then there was another, I think yesterday. So actually, we had some pretty disappointing sort of lending credit data out of China yesterday, but which you kind of expect. And I think the story that the credit data out of China is telling you is that there's a real lack of demand for credit in China. So they really need to kind of stimulate that side of things.
So the worse the data is out of China, the more they have to do, the more bullish it is really for risk assets and liquidity.
And like, local media were kind of, again, it all feels like trial balloons, that they're trying to gauge like where the market's at and what the market wants. They kind of floated the idea that they're gonna, in terms of funding some of this deficit spending that they're gonna go on, they might issue about 6 trillion yuan of ultra long bonds. Now, the interesting thing with that is the PBOC, the Central Bank of China, are able to participate in the ultra long bond issuance in the secondary market. So, and they can do it under the guise of like stabilizing the market and providing liquidity. So effectively, again, it's kind of like QE, but with Chinese characteristics. And I guess my takeaway from this, and I've had lots of conversations this week, and you get lots of clever analysis around it and why, it doesn't mean that much because it's going to disappoint because this, that, and the other. I'm like, look, China are throwing the kitchen sink at this thing, and they've got this kind of open-ended approach to it, and don't overcomplicate it. They are going to be injecting a shit ton of liquidity into this market, right? And I agree, it's probably going to have, they're not really addressing the structural issues. They've got like a consumption problem, and I'm not sure what they're going to do is going to necessarily spark consumption. But again, what they'll do is it'll find its way into financial markets.
Yeah, yeah.
And I always say the financial markets and the financial economy is not the real economy.
Not at all.
And they can pump that up, and that liquidity will find its way into all assets. And
Okay.
you know, rising tide lifts all boats, and I think all boats have been lifted, and the Bitcoin boat gets lifted highest.
So apart from China, obviously that's bullish, but Trump odds are flying.
Yeah,
right?
he's climbing. Yeah, so
Yeah. Why is that? Why is he climbing so much, do you reckon?
I think Kamala's speaking more.
She's doing an interview with Fox tonight, apparently.
Yeah, and like she's a car crash as well, right? I mean, Trump can be a car crash when he speaks, but
Yeah.
she is as well. And like, I mean, I kind of think the Dems needs to go back to like, actually, it was probably working just have her not say anything. But then I think that side.
No, but they were starting to.
Yeah.
That was. They were starting to get heat about that as well.
Yeah. So, but yeah, look, he's climbing in the you know, certainly.
That's why equities are making new highs on that. I think that's the big driver.
Yeah, I mean, yeah, like it's quite possible, right? It's certainly we've now gone to like 57%. I think odds that he's now priced. He's doing better in the prediction markets than he is in the polls, but then you know, prediction markets where people.
Oh, the polls. The polls are completely unreliable in my view, right? Because the polls are based on what people are willing to openly disclose when asked, right?
Yeah.
So there's different types of polls. There's polls where you're on the phone with a human being, but I mean, I remember like in 2016, there were some polls that were done with like with automated voices.
Yeah.
So it wasn't a person that you were speaking to, and there was a significant difference in the results of those polls compared to the polls when it was real people on the other end. So people just aren't honest about whether they're going to vote for Trump or not a lot of the time because they feel like they're going to get ridiculed about it, right?
Yeah, and it's the dirty vote, right? And the dirty vote typically gets underrepresented in polls, so you're probably actually doing a lot better than.
Yeah. So the prediction markets are people have to actually weigh in and put money on those, right? And yeah, I would guess they are probably more accurate, right?
And I think the other thing I've spoken before about this, what I see as an asymmetry into this election, because Kamala wins, it's kind of status quo. She's also making more positive noises around crypto.
She is.
I mean, Gensler's still, I don't know what games he's playing, like the sort of recent stuff with Cumberland. I don't know if you saw that.
Yeah.
But like, you know, he just continues to go after these cases that he looks destined to lose. And it kind of, but that aside, Kamala's making more positive noises. Obviously, if she wins, it's less positive for the market, but it's not a big deal. I think the other thing, like the big risk with Kamala was, you know, all the nonsense around like the unrealized capital gains taxes and all that. I think what's becoming clear is that even if she wins, like you're probably gonna, you know, they're not gonna sort of dominate Congress and all that stuff. So you have like a split Congress.
Won't be a sweep.
And basically means she's not going to be able to do anything. And that's actually positive, right? You don't want Kamala being able to do anything. So if there's that kind of stalemate for 4 years, that's actually positive, like for markets. You know, whereas Trump, and to be honest, even if it's a split Congress, Trump's probably not going to be able to do much either. So we just have this kind of stasis for 4 years, and yeah, I think big picture is probably not that relevant to crypto anyway. Yes, we want like a regulatory framework. Yes, Trump is going to certainly from the noise he's making, more positive. But yeah, I think the market's starting to maybe kind of go, we're tapering off that downside risk a little bit in terms of like a Kamala whitewash, which doesn't look like it's going to happen.
Price action definitely looks pretty strong here, right? I mean, double testing that 60K area for the second time and held beautifully, right? And October now looks like it's game on.
Yeah, we spoke as well, by the way. The October gains typically come in the second
half,
right? So we're primed for that.
Yeah, so looking at the options market, I mean, realized vol has been fairly stable. We've got about 40 vol on Bitcoin, 50 vol on ETH. Implied vol-wise, Bitcoin's at about 45. Implied on ETH is about 50. So it's about a 5 vol spread. So ETH was trading maybe 7 over. Now it's down to about 5 over. Generally, the front of the curve is better bid. So as we've had this pretty sharp move up, the front is like up by maybe 3 to 5 vol points. The back's kind of not really doing a lot. In terms of flows, generally people have been kind of offloading March 100K type calls to roll them kind of shorter. And they've also been like rolling down like 100K and 90K December strikes into like the 80K strikes. You know, before people had bought all those quite high target zones, but it's just been eroding and decaying away. And they're like, I don't want to be in a situation where I own it out of the money call and we rally to 85k and I make no money, right?
Yeah.
So you have to roll your stuff down to something that's got some meat on it, got some delta on it. So that's the general flow that we've been seeing. Skew has been fairly stable in the kind of midterm where it was already for calls. There was like that inflection point in the election bucket where it flipped into call premium past November. So generally that was the skew market telling you that post-election it's all upside risk basically. But even the front end now, even the front expiries, because of this pop that we've seen, like we're imminently potentially breaking now, right? We're at 67k. So even the front end has like got rid of all its put premium and is now priced in call premium.
Yeah.
Yeah.
Yeah. I mean, so the flows on the option side are obviously very bullish. I think one thing that stands out to me though, there's no kind of signs of euphoria. Like at the moment, it's all felt quite orderly. Like there's been an orderly grind. I mentioned yesterday on Twitter or X. It's been quite nice price action. It's been like a grind higher. I mean, actually, before we come in here, we had that pop above 67k and obviously a bit of a sort of stop loss run higher.
But you know, since March, we've just been sideways, right? So I guess that's kind of got rid of the euphoria, right? Every time we've tried to rally, it's failed, right? So I think you need a conclusive break of 72 to suck in that money, and then that euphoria starts to come.
Yeah, right? and like I know something we've kind of disagreed on a little bit is, will equities have a correction into the election, which
it don't look like it, does it?
And then can I mean, we spoke with Rao and Michael in the studio last week about how much the elections may be holding back risk taking and whatnot. One of my things though is that I feel that this market's underpositioned risk in equities in crypto, and particularly if you're like a benchmark sort of fund and you're underweight your benchmark, be it S&P, be it Bitcoin, you're then forced to kind of stop into the trade and chase it. And I know we spoke about, well, maybe you just buy calls or whatever, so you've still got the upside, but I think there'll be some mechanical reweighting higher just because they have to. So you've almost seen you just got this false chasing, and I still feel like the pain trade is higher. And ironically, and a few people push back on me, which is fair. I understand why ahead of the election, and that's been the one part of the puzzle that if I said why we might not, push on, that would be it. But ironically, the more people that think we can't make record highs ahead of the election, and the more likely we're going to, because it catches everyone probably underweight, underpositioned, and it's like, shit, we're just about to push new highs. So.
I think you've got to also kind of think about the game theory aspect, right? It's like if Trump's odds are flying, and you got these big like hedge fund types who are like just waiting to buy on a Trump win, and they're seeing the odds increasing, they're probably already buying some. Do you know what I mean? They're already putting capital to work. If they know you're going to get, they will probably remember how much stocks rallied when Trump got in 2016, right? And they're thinking, I don't want to miss the rally that's going to come when he gets in. So there's part of that. As long as it looks like he's the one who's going to get it, then it makes sense that equities get bought because of it. So I think it is quite important what his odds do for stocks right now.
Yeah, and I just think as well, though, for me, it's just that asymmetry in the risks. Like, because if you kind of think about the Kamala scenarios, then you're like, well, that does much change. So it feels like probably limited downside to actually explosive upside. Yeah. I guess maybe the risk that's a lot harder to price is what you've discussed around, if there's a contested election and all that.
Yeah, but again, the risk of a contested election is more likely if Trump loses.
Yeah.
Right.
Yeah.
So the more his odds improve, the lower the chance of contested election. Right. So then you don't have that wild card and that uncertainty cloud hanging over markets. Right.
Yeah.
So yeah, I mean, volatility. It's interesting. Vol was quite well bid in stocks like up until last week. But we did finally start to see some selling, and this week we've seen some selling as well. It might be options expiry related.
Yeah.
So I would think maybe we get some sort of bounce in vol. If it's weak this week, then I think we'd get some sort of bounce in vol into the election, like just before it. But in general, like if you do get a vol spike into the election, the good high expected value trade is to sell that vol spike.
Yeah.
Because especially into December, into Christmas. normally markets rally and vol gets whacked, right? So,
Yeah.
I mean, that's going to be your highest expectation trade, I think.
And I'm always interested how you have you changed anything in terms of your
So in
positions?
crypto, I'm actually fairly light on my hedges right now. I've got a relative value trade in calls where I'm long Bitcoin calls and short Ethereum. I've had that on for a while. That's still there. The hedges any hedges I did have were quite short dated, so they've kind of eroded away, right? So I'm just kind of long at the minute. I did add some calendars, so things like, where the 8th of November expiry was kinked because of the election.
Yeah.
So kind of selling calls in the 8th of November and owning them at the end of November and kind of using that calendar, because it might be like you get the knee jerk higher on the election and then it kicks off a trend and you continue to rally. So the pricing of those options, I think, kind of gives you quite a nice payoff like in that calendar. I mean, obviously we could do something stupid on the election and be at 90K, but I just don't expect it. I think we kind of find ourselves rallying towards 80K maybe by that election week. And then if that's where we are, then we can kind of continue into the end of November for the Q4 rally. And then who knows how far we get. Maybe 100K is possible, right? So that calendar can work quite well.
Yeah. 100K.
100K Bitcoin.
100K. I think we see it by year end, for sure. And yeah, it feels good at the moment. And the biggest worry is I'm not seeing too much to worry about. I think that's the
biggest worry.
Yeah, that is the biggest worry.
So what happened? Bit of a different guest this week, right?
Yeah. So interesting this week, a little bit different from our usual. So I caught up with the CEO and co-founder of Sunzu Labs.
Okay.
Stephane Reverre. Really interesting. So what I love about like some of these guests we have on is like there's so many sort of vital pieces of infrastructure and services that this whole space needs to really sort of grow and allow for that adoption. And they're providing like liquidity reports for token issuers and market makers. And again, it's like we had a really good discussion around like, just how we still kind of lacking some critical infrastructure. And they're sort of trying to provide part of that. So yeah, a little bit different. I learned a lot, so I hope you'll all learn a lot too. So
let's see.
Yeah, take a listen.
Hi guys, I'm pleased to be joined today by Stephane Reverre, a co-founder and CEO of Sunzu Labs. Sunzu Labs they're a leading provider of liquidity analytics in the space. Stephan, welcome onto the pod.
Thank you very much, David. Thank you for having me here. It's a pleasure to be here.
Great to have you on. I guess a good place to start for those who don't know you, be great to learn a little bit about your background and your path into crypto. I know, like many of us, you've kind of come from the traditional space and found your way into crypto. So yeah, would love to hear some of that story.
Exactly. I'm a TradFI guy. I've been in TradFI for 25 years before jumping into crypto, and I started my career in the early 90s in capital markets on equity derivatives, and back then I was in Tokyo. So I had the pleasure of knowing the Tokyo market just after the crash of the end of the 80s. It was very, very strange place, very interesting and enlightening. And so my career has really been around equity derivatives, and specifically around two compartments. One is electronic execution, what is sometimes called StatArb, arbitrage, statistical arbitrage and that kind of thing, and cash and carry. And the second part was about securities finance. Now, those are businesses in TradFi, which really means, number one, you transact, and number two, you borrow and you lend. And as we were discussing before, interestingly, in crypto, we've seen those two waves appear. The ability to transact, buy, sell crypto, all sorts of products, all sorts of assets. And then later on with DeFi appearance, and you can now lend, you can leverage, you can do a number of different things when you have inventory. That's what I've been doing all my career. So it was very natural for me, when was it, 2016, 17, to wander around and say, look, what are we talking about? What are those things? Bitcoin. I had a very good friend who was already in it, was talking about it. Said, okay, come on, guys, you buy a pizza with it. What can you do with that stuff, right? What is it, in fact? It took a little bit of time. And I confess, it was difficult to get into it because we are so formatted by TradFi environment that the crypto thing was literally out of this world. So I looked at it, I discussed, I read, and I figured, okay, what about liquidity? If that thing that Bitcoin everybody's talking about is to become a big thing, it needs to have liquidity. That's the starting point. And so I started looking at liquidity. I wrote a couple of articles, but I liquidated myself. And eventually we ended up with an associate, with Vincent, my associate, we ended up starting Sunzo, which what we do is we look at liquidity and we try to understand the crypto liquidity. So that's all the journey. And today, I'm not a Bitcoin maximalist. I don't saying that the world will evolve on Bitcoin and so on, but I do believe it has added, first of all, questions about TradFi. TradFi has starting asking questions about itself, and that's very good. And number one, it offers alternatives and different options about the way money is going to be transacted. And again, that's, I believe, a very good thing.
Yeah, for sure. It's funny as well that crypto seems to, certainly from the institutional side, lends itself very well to like, a lot of equity derivative guys seem to come into the space because I think there's so many parallels in terms of what we're building, and also I guess the some of the issues like that the traditional derivatives markets faced in terms of the lack of transparency often like within that space. Crypto kind of can solve for a lot of those problems, which I always think is really interesting. When you look back to the Lehman blow up, and I was there then.
Don't get me started on the Lehman blow up. It was such a mess. But the reason why equity derivatives guys, I believe, tend to love crypto, or they're looking at it with a lot of curiosity, it's because the Bitcoin and all those assets are very similar to equities, and then they're also very similar to currencies, and then they're very similar to commodities, which, by the way, explains why regulators worldwide have so much difficulty categorizing them. But so you have all the characteristics of a good old-fashioned stock with the derivatives on top of that, and then you have what the equity market lost. You have a fragmented market. We lost that in the 90s, and so for the end investor, a fragmented market is a pain. For a trader, I mean, it's a field of opportunities. You can do many things. It's unregulated, or it's relatively unregulated. So it's a playing field, fantastic playing field, where you find all the excitement, all the action, and the margin that you found 20 years or 25 years ago. And so it feels like we're back in the old days where trading was fun. I mean, a lot of my friends tell me it's not fun anymore in banks and hedge funds. Okay, you make money and blah blah blah, but the fun, regulation, and the sophistication of markets have taken all the fun out of it. In crypto, you still have fun, and that's quite something, I would say. Yeah,
like sure. I mean, I think many of us who come into this space, feel that, and it kind of should be fun, and traditional markets almost became a victim of their own success in terms of how efficient they've become, and we'll probably go down a similar route in crypto, I'm guessing. But it's like you say, there's still a lot of fragmentation. Which creates so much opportunity, and I think we've still got a very good run ahead of us with a lot of money to be made. And obviously Imran and I spent a lot of time talking about volatility in the option space. I just find it, as someone who came from a foreign exchange world, if you're, say, a vol trader in the FX space, why would you not be interested in crypto when, we're trading on, 70, 80 vols in this stuff? You're getting excited if you're a Eurodollar trader, and if you, I think last year we had like a spike to like 10 vols, and now we're probably back down to, check the line, about 5-6 vols or whatever on Eurodollar. So it kind of just feels like an obvious market if you enjoy trading, particularly, that you want to be involved in. A, it's fun, and B, there's so much opportunity in the space. So
but then we make it sound, being what we are, we make it sound like it's only for fun. But at the end of the day, we should not forget it's a new asset class. Not yet, but it's becoming a new asset class, and it's a diversified one. And so if you have a new compartment where people, retail, corporate, or institutional can allocate money, small money, because there are so many issues and risks that you should not consider it. You should not go all in like some people do. But if you allocate a little bit of money and it's diversified and you have volatility, it means it's a full-fledged investment compartment. And so for individual investors or for final investors, that's what it should feel like. It should feel like it's a compartment that's going to help me diversify my exposure. It's a new source of risk. And okay, it's fun, but it's also a bona fide trading opportunity and a long-term investment opportunity, provided you respect certain rules, provided you don't, you diversify, you take the measure of the risk that you have, because it's a very risky compartment. And there are something new, by the way, is a technological risk. TradFi has mostly eliminated the technological risk, or it's encapsulated. But in crypto, you have that. So if you carry that risk, then you're going to be, you're going to have return on it. So it's one more choice that you have. Which technology do you believe that's going to end up making difference? And you have thousands of choices. So it's very rich. It's very educating. It's trying to solve a lot of problems. So for the end investor, it's full of discovery and rewarding discovery. So it's not only a playing field for us, it's also an interesting discovery opportunity for people who are just curious. And they can make money, by the way, also. So why not try it? Why not?
Yeah, sure. Yeah, and again, like for me, it's the future of finance, and we've got an opportunity to rebuild a lot of the financial system, the bits that we liked, and then also improve on the bits that were inefficient. And I think we're making good progress on that. So I guess on that, it'd be great to hear more about what you guys are doing at Sunsood and your focus on liquidity and the kind of role and service you're providing there.
So when we look at liquidity early on, we figured, okay, in the TradFi, it's regulated, liquidity, execution, all those things. When you're an investor, institutional investor, let's take Fidelity, for example, and you want to execute on equities or on fixed income, then you are going to put your broker on the line. You are going to ask your broker, you have to show me that you're the best because I'm being commissioned. And why shouldn't I give my business to another broker? That's the point, the vintage point we started from, saying investors will have to have accountability in execution and accountability in the way orders are filled throughout the market. Okay, fair enough. We discovered that nobody cared about that early on because there was so much money to be made. Nobody cared about execution. Okay, so we pivoted sort of. We asked different questions, and what we found is, why is the liquidity important today? And investor, individual retail, community members, they want to be able to buy and sell their token easily. That's the starting point. To be able to buy a token easily, someone has to maintain a market. Those are market makers. And at the end, you have a token issuer who is not responsible, but who has some sort of mandate to make sure that the market is behaving properly, because that's in the interest of everybody. Okay, so that's three-party. We focus on the B2B section between foundation, token issuer, and market maker. And what we say is, look, there's been a lot of things going on. There's been good and bad. There's been brokers and issuers playing with the token, with the price, with volume. We believe at Sunsood that in the end, it's everybody's interest to have an orderly market, and the issuer and the market maker should take their share responsibility in making that happen. So what we do is we provide a dashboard. Okay, we are fully software. We don't do any transaction. We are not market makers ourselves. We provide a dashboard for the relationship to unfold correctly between a market maker and the foundation, a token issuer. Market maker has KPIs. The foundation has expectation. There is a contract. We make sure that the contract is being fulfilled on both parts. And for that, we look at price, volume data, and we publish all the KPIs so that everybody knows that the relationship is in place. And we find when we go to conferences, we talk to market makers, and mostly we talk to issuers, and we ask, are you happy about the market for your token? are you satisfied with the way the market functions? And most of the time we're getting no, we are not. So we're trying to improve that. We're trying to improve the market for the token so that investors or token issuer get more out of the token, the transaction and market.
And where in the cases where it's not working so well, like what's typically like the common kind of themes and issues where those relationships break down and the liquidity relationship breaks down?
It's really mismatched expectations. Okay, so we talk to token issuer and they say, look, I want the market for my token to function properly. But what they're really saying is, I don't want my token to go down too much. Okay? We go to market maker and say, look guys, the token issuer may not be entirely happy about it and so on. The market maker says, look, I'm not a miracle worker. I'm trying to bring liquidity. I'm trying to provide bid offers. I'm trying to provide market depth. But if the market goes down by 15%, I am not going to put my capital at risk to maintain an artificial level for the token. So here you go. You have mismatched expectation. Expectation on the market maker is, I'm going to provide liquidity to a certain point. Expectation on the token side is, I don't want my token to go down. So when we say we're not doing any consulting, but we are talking to everybody and we're saying, look, you have to calibrate your expectation. The market maker should do its part. There are KPIs in place. There is a contract, and those KPIs are market depth, spread, and so on. Those are metric on the token. And to the foundation, we say, look, if the market maker is respecting and behaving on its KPI, this is all the expectation you should have. Expectation about the price of your token is misplaced because it's called manipulation. Market maker is not going to enter into manipulation about the price, and it should not have to do that. So you, foundation, should be aware of that. Don't expect the market maker to maintain artificial prices when the token is going down or the token is going up. So it's a long answer, but so it's mismatched expectation on both sides. And like many instances, if you provide data and if you provide a clear picture of what's going on, then you help dissolve those expectations into a better relationship.
Yeah, sure. How important, I guess, within that, and when I think of like new tokens that come on, obviously exchange that you list it on is going to play an important part. Obviously bigger exchanges naturally have, sort of more liquidity, more demand on the border exchange. How big a part is the kind of community a token is built up around it, and the kind of, that natural demand from that community play a role? Because I hear about, people want to launch a token and and everyone wants everyone into it, and then they obviously hope that they stick it on an exchange and they're gonna just see activity and demand within it. But yeah, how much is our responsibility on the token issuer in terms of just building the like the marketing aspects around the token and what they're doing and building the community around that, versus if I'm a market maker and I'm trying to provide liquidity in this token, at the end of the day, if there's just not the demand and interest in it, like you say,
Exactly.
that's what you can do, right?
I mean, you're right on the point. The responsibility is mostly with the token issuer in terms of marketing and so. I mean, I'm going to say something obvious, but if you launch a token for a project that doesn't deliver any value, your token is going to tank. Okay, that's just obvious. It's a question of time. You can maintain in under artificial life, sustain whatever you want, but it will, at the end of the day, it will crash. So that's also, by the way, a mismatched expectation. Token issuers, especially before the launch, they believe that market makers are all powerful. They believe that if they have the right combination of exchange and market maker, then the token will go to the sky. No, guys, it just doesn't work that way. You have to have the right market maker. That is the one where you have clear communication. The exchange is important. But again, there is a question of prestige. Everybody wants to be listed on Coinbase. Okay, but what you want on the exchange, when you pick an exchange, you want an exchange that has low counterpart risk. Prestige itself doesn't do it. You have to have a safe exchange, because investors will not come. Even if they want to buy your token, If the exchange doesn't offer the right safeguards, security in place, then your investors will not come. So the exchange, you should recognize a good exchange, a safe exchange being the top priority. And if you have a famous one, or if you have prestige, okay, that, of course, everybody wants that, but it's not necessarily what you want day one or what you can afford day one. So pick the market maker, pick the exchange, but at the end of the day, you have the money, you have the right to contract, you have the right and to specify the KPIs, and you maintain the marketing in your community. You are responsible for making sure that there is enough interest. If there is enough interest, then there will be volume. It's very, very related. If there are enough people looking at the token, if there are enough people that believe that you are delivering value, that the technology behind the token is worth something, then liquidity will accrue. So it's like kickstarting when it's very cold and you're trying to start your car and you cannot start your car because your battery is dead, and you have someone lending you cables and jump starting your car. That's exactly how people should see market making. The good market maker is the one that disappears. After a year, you should not see the market maker in your book because there is enough liquidity interest, and the market maker is just there just in case, but it's mostly not necessary. It's like jump starting your car. After you jump start your car, you don't need the cables anymore and you're fully autonomous. So that's what token issuers should have in mind. I need to set the stage so that for the first 6 months, first year, I'm pumping liquidity in, but I'm also making everything possible for the token to build a community, for the project to build a community. And after that, it will become self-sustaining. And that's what you want. You want self-sustainability. Because if you artificially maintain a market for your token, it's going to cost you money. And market makers are going to take risks, sometimes risks that they don't want to take. And exchanges are going to see that your token is going nowhere, that volume is going through slow attrition. And at some point, they will decide that they want to delist you. Self-sustainability, it's a combination of the right exchange, the right market maker, and the right marketing / community. And all of those are under the responsibility of the token issuer. And when you have a successful issuance, when you have, 50, 60, 100 million, or even more than that in your coffers, then you have the time and the resources to build that community. And you should certainly get that very, very serious job underway as soon as possible. So another way of saying that is, don't rely too much on your exchange. Don't rely too much on the market maker. Those guys are not miracle workers. They do provide a service. It's very valuable. It's very important early on. But it rests with you, token issuer, the project, the core dev team, whatever it is. It rests with you to demonstrate that your token is going to create value and your project is going to create value.
Yeah. And in terms of your interactions with your clients then, so, you're obviously going to be an important part of the early part of that journey of sort of listing the token and providing that sort of analytics. And then does it get to a stage when, like you say, it becomes sort of self-sustaining and then the kind of value adds from Santu Labs is kind of less, or are you with them throughout the whole journey, even as these tokens really start to get
so we are. It's early to say that we are with them the whole journey because the journey has just begun. But it's like going to the doctor. Okay, you go to the doctor, you pay for your regular checkup, and you hope that there's nothing to say. It's same for us. We have the terminal, we set the dashboard, and we tell our clients, look, guys, hopefully you spend money for us. Okay, we're not free, and we deliver a service, but we hope that you'll have less and less use for us. That we hope that at the end we'll still keep us, because you need to look like you need to go to a checkup every 6 months or every year. But it's a non-event. And we are very, very fine with that. We should, in an ideal world, trust doesn't preclude control, as we say in French. I'm not sure the same saying goes in English, but you can trust someone, you can trust your market maker, you can trust a lot of people providing liquidity in your token. Doesn't mean that you should not control that everything is in order. And if you control, and if there's nothing to say, nothing to see, you're fine. But you still need to go to see the doctor. We are the equivalent of a doctor. Except we don't prescribe, we don't have any magical remedy, and so the analogy has its limits. But come to us, and if there's nothing to see, everybody is happier.
But if there's a potential problem, you'll pick up on it. Interesting. What's your kind of view at the moment in terms of like how liquidity's evolved since you've been doing this?
Well, the general trend is that what we believe is that liquidity is going to concentrate a lot. It's going to concentrate on tokens and concentrate on exchanges, because fragmentation, there are two sides to fragmentation. There are a lot of tokens that, by the last count, we found there are 5,000 tokens with some sort of capitalization, and there are hundreds of exchanges and DeFi platform. It's too much. I mean, come on, it's not a very smart thing to say, but it's way too much. The capital available to fund and finance the crypto space is not unlimited. So for every buck that is being invested, if you want that dollar to have an impact and deliver value to whatever it is, to end users, current end users, future end users, that dollar needs to find its way to some productivity, some project, and so on. So there is too much fragmentation, and that we think is a problem, and we think that nature will concentrate when the natural the development of things like it happened on the traditional markets. We think that it's going to concentrate on, I don't know how many, and I will not give a number, but on a smaller number of tokens for sure, and a smaller number of exchange. So a lot of people are going to die. Number one. Yeah. A lot of people are going to go out of business on the token, on the technology, on exchanges, because there are way too many of those. Number one, and it's a good thing, right? The capitalism, conventional wisdom is that there's this invisible hand and so on, and capital would find its way. We are in the middle of it right now, so it's not pleasant for everybody. But so that's why we believe that it will happen. It's happening today, and then it's for the best. And the liquidity will concentrate, which is a very good news for what's left, because then you will have much more fundraising opportunity. Because when you have liquidity concentrated, when you have exchanges that have been vetted after 5, 10, 15 years of operation, that they can be trusted, that they are being managed properly, that the regulation is being respected, whatever regulation it is, that investors don't lose their money, that exchanges are not being hacked, projects are not being hacked. Time helps. You can say whatever you want. People say we need to go quicker and quicker. No, if you have corporations that have been in existence for 150 years, and that is inspiring. So time will concentrate. The winners will have much more opportunity to fundraise, to finance themselves, and finance other stages, and that's for the better. It doesn't prevent innovation. It doesn't prevent new projects coming in, but it will get more organized, and liquidity will find its way. And by the way, for derivatives product, options, and so on, it's also a very good thing. Like the thing we haven't seen, for example, on crypto is a structured product. A structured product, financial engineering, and complex payoff are very common in TradFi. None of those have emerged yet.
And I say we're slowly emerging. Still finding it, and
it's very early. The reason is, one of the reasons I venture is very important is the lack of liquidity. Because when you have a structured product, you've seen that you have gap risks, you have all sorts of liquidation risk, you have margin calls, and you have all sorts of issues that make it very difficult for you to issue a product, manage that product with a relatively well-known risk, if you cannot hedge properly. That is the next wave, or that is a new wave. When you have concentration on liquidity, when you have fewer exchanges, when the counterparty risk of exchanges is being better assessed, then things become possible on the derivative side. Because the thing about derivative is you get leverage. We all know in the industry, when you get a derivative, you have leverage. When you have leverage, you have a recipe for disaster in the wrong hands. When you have a spot product, okay, you need to settle, you need to pay 100 Bitcoin, you need to pay that much money. But when you have leverage in a financial system, whatever it is, it becomes much more risky. So liquidity concentration that will enable better management of counterpart leverage risk, that will enable new products, such as structured product, on-chain and off-chain. And the thing about structured product is because you can manage risk better, you can tailor risk to a whole bunch of new investors that were not addressable before. And here you go, you find new use cases, you find new risk to package, you can put that in funds, you can put that in retail, you can slice and dice the risk the way it's been done in TradFi. And we've seen, in the 90s and after that, we've seen the powerful wave of structured product, especially on equities. And that wave is just waiting to happen in crypto. So, and all of that because you have, we can compare that to international commerce. You have when you have shipping routes that are safe, well protected, when you don't have any rock, anything, any danger left because the map is clear, suddenly the commerce, picks up dramatically.
Yeah.
Same thing here. Liquidity, again, if it aggregates and so on, everything I said, we'll be in a much different world where I think adoption will find another different engines and newer engines.
Yeah, I completely agree. And this is why I still say to people, we're so early in this space still. There's so much infrastructure to be built. There's so many services that are still required to allow this full adoption, and certainly from an institutional side. And very, very much to your point, the kind of services, the transparency, all these things that they'll need, that will enable a much greater explosion of the derivative space, which is still relative to TradFi, a really sort of small sort of part of this space.
And you know what I would like? If you ask me what I wish for, I would like people to talk to each other.
Yeah.
Because, in TradFi, is that, all the things that there are some professional organizations that have come together to try to structure the effort, to try to standardize and so on. Okay, I understand innovation doesn't like standardization. Everybody wants to have his own project because they think they're the best and because they think that they will win in the end. Fantastic. Guys, let's wait that a second to the bigger picture. The bigger picture is if we get together, if we get some standards in place, okay, for example, cross-margining across exchanges. It's a crazy thing to say, cross-margining across exchanges. But if I was able to trade on one exchange and then suddenly transfer without a cost, without friction to another exchange, that would change my life.
Yeah.
So let's get that in place. Okay?
Yeah.
It doesn't have to be a clearing house like TradFi, but some sort of functionality it makes sense. Anyway, so looking in the same direction, trying to push in the same direction, which doesn't happen today, by the way, or very, very little of that. That would go a long way in my mind to pave the way for a better future.
Yeah. Well, look, I hope here on this podcast we're helping at least educate and provide some information to facilitate that conversation. And that's probably a good place for us to sort of wrap up. Stephan, thanks so much for coming.
My pleasure, David. My pleasure.
Yeah, it's been a little bit different from some of the stuff we usually talk about, but again, just a really interesting part of this market. And great to see what you're doing in the space. So thanks very much.
Thank you, David.
Okay, great discussion, mate. So yet another equity derivatives guy coming into the crypto space.
It's actually all the best equity derivatives guys coming to crypto.
The brain drain is unbelievable.
Yeah, it is. And Druckenmiller says, follow the talent. Yeah, and it's interesting, just seeing sort of guys like that come into the space and see the opportunity as well.
Yeah, because obviously, a lot of this podcast is about what's going on in markets, and we talk about trading and we talk about timing the swings and the option trades that I'm doing and stuff. But it is always nice to get people on who are building out the infrastructure, right? Because it reminds us that it's still very much a growth area, right? It's not like banking, which is secularly declining, right? There's more and more people coming to the space. There's more and more stuff that needs to be done to then have the pipes for people to provide liquidity and just get, for this space to just have bigger and bigger adoption, right?
Exactly. And Stephan sort of brought up the good point as well, that these markets are still very fragmented.
Yeah.
Which in some cases an issue, and that's why, we need some of these services. But also for a trader and that, it's just such a massive opportunity.
Yeah.
So there's still we're still so early in what we're building. And that's why like it's really hard not to be long term like super bullish, because you know, as much as we've come so far in a really short space of time, but you know, we talk about like the ETF inflows and still like a lot of that's, you know, not really like the big guys coming in, and not the big like hodlers that are going to come in. You know, a lot of that's people, as we spoke about last week, are you know, playing basis trades and stuff like that. But there's just still so much money to come into this market. And yes, we are going to need the infrastructure to allow it, but it's building and it's happening. And it's hard just not to be super balled up this space for the next however many years.
Yep. Well, finally, looks like the Q4 rally's on. Fingers crossed. All right, guys, we'll call it a day for today's episode, and we'll catch you next week.